Okay, so you own some money in a bank account. You can see it. It's on the screen, in your name, down to the last cent, and if you walked into a branch this afternoon and asked for it, you would get it. That feels like ownership. It behaves like ownership. The picture in your head is probably a vault. Somewhere behind the counter, a heavy door, stacks of notes, and a portion of that stack is yours. Here is the actual number. Across all American commercial banks, the physical cash sitting in vaults and tills is worth less than 1% of the deposits those banks owe their customers. That is not a rounding error. That is the whole holding. For every $100 in the country's accounts, there is well under $1 of paper behind the counter. So the title of this video is true, and it is true within 30 seconds, which leaves the harder question. If the money is not there, what exactly is the number on your screen? It is not a receipt, it is an IOU. When you deposit money in a bank, you are not storing anything. You are lending. You become an unsecured creditor of a private company, the same legal position as a supplier who has not been paid yet, and that company promises to repay you on demand. It is the same question that decides who really owns Bitcoin sitting on an exchange. Not whose name is on the balance, but who holds the asset. Your balance looks like storage. It functions like a loan you did not know you had made, at an interest rate you did not negotiate, to a borrower you never checked. English law settled this in 1848 in a case called Foley versus Hill, and then everyone forgot. The entire modern system is built on top of that forgetting. Hold on to one number for the next few minutes. $42 billion in a single day. We will come back to it. Because the money did go somewhere. It simply did not stay. Follow it out the back of the branch and it splits three ways. The first and largest destination is loans. American commercial banks hold roughly $12.6 trillion in loans and leases. Mortgages, car finance, business credit lines. Your deposit is inside somebody's house and it is inside somebody's payroll. The second is securities. Around $5 trillion sits in bonds, mostly government debt and mortgage-backed paper, which is a bond built out of thousands of individual home loans, bundled together and sold as one instrument. These are contracts with maturity dates. Some of them run 30 years out. The third is reserves, meaning the bank's own account at the central bank. That is the only pile that is genuinely liquid, and it is the smallest of the three. Now hold those three against the promise. Loans lasting decades, bonds maturing in 2050, and an undertaking to repay every depositor instantly, on demand, in full, on any Tuesday afternoon. Banking is not the business of keeping money safe. It is the business of running a permanent, deliberate mismatch between how long money is lent out and how quickly it can be demanded back. Every branch, every app, every marble counter is a defense built around that one trade. The whole industry is a bet that not everyone asks at once. That bet has a name, and it has a price, and both are stranger than they sound. Think of a cloakroom at a theater. You hand over your coat, take a ticket, and expect the coat back at the end. Now imagine the cloakroom notices something. On any given night, almost nobody collects early. So it starts renting the coats out to a restaurant down the street between the interval and the curtain call, and keeps the fee. Nothing goes wrong as long as the coats come back before the audience does. That is the mechanism. There used to be a legal floor underneath it called the reserve requirement, which was the minimum share of deposits a bank had to keep on hand rather than lend out. In the United States, that floor was 10% for large banks. On March 26, 2020, the Federal Reserve set it to zero, not lowered. Zero. There is currently no legal minimum share of your deposit that an American bank is required to keep. In practice, banks hold far more than zero because they need liquidity to operate at all, but the floor is gone, and it is worth knowing that it is gone. Now the profit. The bank pays you something small to hold your deposit and charges its borrowers something larger. The difference between those two rates is called the net interest margin. Across American banks, it runs at roughly 3.2%, meaning that for every $100 of assets the bank is working with, about $3 a year stays with the bank before costs. On trillions of dollars, 3% is an industry. That gap has a name you might recognize. It is the spread. Here is where your own money is standing inside that sentence. The national average rate on an American savings account is under 1%. The rate on a 30-year mortgage has spent the last 2 years somewhere between 6 and 7%. You are supplying the cheap side of a trade and paying the expensive side of the same trade, frequently at the same institution, and the distance between the two is the product being sold. Then there is the part that breaks the intuition completely. You almost certainly assume that banks lend out deposits. Money comes in, money goes out. The bank sits in the middle as a middleman. The Bank of England published a paper in 2014 explaining that this is backwards. When a bank makes a loan, it does not move existing money from one place to another. It types a new deposit into the borrower's account. The loan creates the deposit. New money comes into existence at the moment of lending, and it is commercial banks, not central banks, that create the overwhelming majority of the money in circulation. So your deposit was probably never anybody's savings. It was somebody's debt, and it arrived as a number on a screen. The coats get lent out. What decides everything is what they get lent out as, and whether that thing can be turned back into a coat on short notice. Walk into a bank's back office, and the risk is not in the vault. It is in a portfolio of bonds, and sitting next to that portfolio is an accounting label that determines whether the bank looks healthy or dead. The label reads, "Held to maturity." It means the bank has formally declared that it will keep those bonds until they mature and will never sell them. In exchange, it is allowed to carry them on its books at the price it originally paid, rather than the price anyone would pay today. Bonds fall in price when interest rates rise. A bond paying 1.5% is worth less once newly issued bonds pay 5%. Nothing about the paper changes. The market simply will not pay the old price for the old income. Silicon Valley Bank held around $91 billion of bonds under that label at the end of 2022, carrying an unrealized loss of roughly $15 billion. The bank's total equity, which is the cushion standing between it and insolvency, was about $16 billion. On paper, comfortable. At market prices, the cushion was almost exactly gone. Quick aside, if you would rather understand these things than be told about them, subscribe. That is the whole pitch. Back to the label. Because held to maturity is a promise, not a property. It holds right up until the moment the bank is forced to sell something in order to pay someone. And the only thing that forces a bank to sell is depositors asking for their money. That is the trap in the design. The accounting works perfectly until it is tested. And the event that tests it is the one event it cannot survive. It has been tested. Twice in ways worth walking through slowly. Silicon Valley Bank spent 2020 and 2021 doing what looked like winning. Venture capital was pouring into startups. Those startups parked their cash at SVB. And deposits went from around $102 billion at the end of 2020 to roughly $189 billion a year later. Nearly doubled in 12 months. The bank had to put that money somewhere. Rates were near zero, so it bought long-dated government and mortgage bonds paying very little, and filed most of them under held to maturity. Then the Federal Reserve raised rates from near zero to above 4.5% in about a year. Every bond the bank owned fell in value. At the same time, venture funding dried up, so startups stopped depositing and began burning through what they already had. Money was flowing out while the assets backing it were worth less than the bank paid. On March 8, 2023, SVB sold $21 billion of the bonds it was permitted to sell, took a loss of about $1.8 billion, and announced it needed to raise $2.25 billion in fresh capital. That announcement was the warning, printed in public. Its depositors were not ordinary customers. They were startups and venture funds, heavily concentrated and connected to each other by group chat. The bank had reported over $150 billion of deposits sitting above the $250,000 insurance limit. Money with no government guarantee behind it. On March 9th, depositors tried to withdraw $42 billion in a single day. That is the number from earlier. Regulators closed the bank the following morning. 40 years to build, one afternoon to unwind, and not a single loan had gone bad. The bonds were fine, only the timing was wrong. Northern Rock ran the same mismatch from the opposite end. It was a British mortgage lender, and through the mid-2000s it grew fast by skipping deposits almost entirely. Instead of funding home loans with savers' money, it borrowed short-term from other financial institutions and repackaged its mortgages into bonds to sell on. Cheaper, faster, and it worked beautifully while those markets stayed open. In August 2007, they closed. Wholesale lending froze across Europe, and Northern Rock discovered that its funding model had a single point of failure: other people's willingness to lend to it on Friday. Every Friday, forever. On September 13, 2007, news broke that it had approached the Bank of England for emergency support. The next morning, people queued outside its branches. Not investors, ordinary savers standing in the street in Britain's first bank run in well over a century. They were right to queue. British deposit protection at the time was not full protection. It covered all of the first £2,000 and only 90% of the next $33,000. A saver with £40,000 in the account stood to lose real money simply by being late in the line. The rational individual move was to run, so everybody ran. Only a government promise on September 17th to guarantee every deposit stopped it. The bank was nationalized in February 2008. Its loan book was never the problem. Its funding was. A mismatch is not a risk that builds gradually. It is a risk that sits at zero until it is total. And that government promise is a political choice, not a law of physics. In 2013, Cyprus ran out of room to make it. Deposits under €100,000 stayed protected. Above that line, at Bank of Cyprus, 47.5% of the balance was converted into shares in the bank. Those depositors did not get their money back. They got equity in the institution that had lost it. So run both scenarios honestly. The optimistic one is the one you are living in, and it works. Deposit insurance in the United States covers $250,000 per depositor, per bank, per ownership category. For most people, that is complete coverage. Failures are handled over a weekend, and insured depositors have essentially always been made whole. This is not a scam. It is a machine that turns idle money into houses and payrolls, and it does that job well. The realistic negative one is a question of proportion. The Federal Deposit Insurance Corporation's fund held about $137 billion at the end of 2024, against roughly $10.7 trillion of insured deposits. That is around $1.30 set aside for every $100 promised. The fund is built to absorb a handful of failures, not a general one, which is why it is backed by a credit line from the United States Treasury. For the same reason a fire brigade is backed by a water main. The insurance is real. It is also not a vault. Collapse the entire engine into one sentence. A bank borrows short, lends long, and keeps the difference. Every other feature of banking is scaffolding around that single trade. The institutions that mastered it are enormous. J.P. Morgan Chase earned roughly $90 billion in net interest income in 2023 from the spread alone, before a single fee. None of this is advice about where to keep your money, and it is not a prediction that anything is about to break. It is an explainer, but it should change what the screen means. Your balance is not a photograph of money sitting somewhere with your name on it. It is a promise from a company that has already spent it, backed by a second promise from a government that has usually kept it. The structure runs on a quiet agreement that almost nobody will ask at once, and it works beautifully, right up until the afternoon everybody does. The people who understand they are lenders get paid like lenders. Everyone else gets a statement.